Welcome everyone to tonight's Hook Up with Real Estate Masterclass. We're excited you're here. We're watching this as a replay. We have a very special guest tonight, John Gravelyn, and we will introduce him in just a minute. Ken, would you please read the disclaimer? Ken?
We appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, tax, or investment advice, nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hook Up with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent to this event being recorded and understand that internet security is not absolute.
Thank you. Well, our mission is to empower aspiring and early real estate investors with exceptional education and valuable skills and genuine opportunities to invest in real estate while sharing strategies that guide you toward success and away from costly beginner mistakes. And we share many of our costly beginner mistakes in this book called Real Women in Real Estate, which is available on Amazon, or I can send a copy, signed copy. Just briefly, Ken is a licensed New Jersey realtor, and he is also a real estate investor, a tile contractor, and a veteran. So if you happen to be in the New Jersey area, northern that is, or want a referral, his website is kenneth-hook.weichert.com. Now, we are powered by Legends Equity Group, and this is one of our multifamily properties. We're also involved with a triple net industrial flex group, which generally is a 506c. We just acquired this industrial flex right in front. The one in back is also owned by this team, so we're excited about that acquisition. And there'll be more to come. All right, there are two ways to connect with us. You can subscribe to our YouTube channel, and you can join our Facebook group. They're both Hook Up with Real Estate. The YouTube has an @ sign in front, and the Facebook is Groups with an S. So please join us. Now, if you have questions about getting into real estate or any of the topics we cover here, feel free to book a strategy call where we give real guidance, real strategies, and real investment opportunities. Now, this is our calendar. It's a monthly calendar. As you can see, we're halfway through the year, as crazy as that seems. And, we have 6 more great master classes after today, so just mark your calendar for these. Now, Ken, would you mind reading the quote of the day?
Yes, every great real estate investment starts with a solid foundation. Anonymous.
Thank you. All right, now we get to the good stuff. We get to introduce our guest speaker. So John Gravelyn is a Michigan-based real estate entrepreneur and investor. He's the founder of First Principles Partners. And First Principles is an engineering term from what I gathered here. He uses a decade of experience as a senior corporate engineering leader to rethink property markets. Instead of leaving his technical roots behind, John now applies rigorous first principles and engineering frameworks as a backbone of his real estate business. He brings a systematic, highly analytical approach to asset valuation, project management, and development execution. Please help me welcome John as he shares his expertise and wisdom on engineering your first real estate deal.
Hi, thanks for having me, Donna.
Sure.
Excited to go over this stuff today.
So
I'll,
we always start with the question, how did you get started in real estate? So,
so I guess the real beginnings where I had a mentor early on in my career who said, "Hey, you've got a job at Ford now. No bank's going to turn you down for a loan. Once you get in, go buy a house. You're already throwing your money at rent. Go buy a house." I was like 21 at the time, and I found a way. I just loved it, and I used a first time home buyer program and was able to put very little money down and got in my first house that I owned and started kind of a slow fix and flip. That's what that was. It was 5 years, and by the time I got it done, we were ready to move and sell, and we did extremely well on the property. The timing couldn't have been better, but I don't take credit for the timing. The timing, no one can predict timing, right? The timing was great, but I'll take credit for improving the house and gaining a lot of equity that way.
all right. Thank you for sharing. All right, so tell us about how we can engineer our first real estate deal.
Yeah, so I'll share my slides now.
Great.
All right, so just our first principle stuff. This is a little bit about our approach that we take, more about mathematics and really looking at the things that can't be retouched with AI. The numbers work, the numbers work. They don't, right? But next, let's look at engineering various investments. We've got different types of investments. I think you guys have talked about them probably in other classes and podcasts. We've got burr flips. Those are value add buys. I talk about live and flips. That's what I've done in the last couple ones. But those work two ways, right? Buy, rent, refinance. Buy, rehab, rent, refinance, repeat. Or a flip, right, where you buy and then you sell. The primary constraint in those situations is going to be capital deployed and human labor. It's a lot of work to flip a house. You take something that needs a lot of work. It needs a lot of work, right? And then the core optimization in that case is going to be forced appreciation margin. The primary difference here is a flip you don't typically hold. A burr you're going to hold for a while. And you're going to take that appreciation out in the form of a loan during the refinance portion. But the forced appreciation margin is the core optimization metric for both of them. You want to take a $150,000 house and turn it to a $225,000 or better house. Whether you refinance it and rent it out or you flip it at the end and just sell it, that's up to you.
So the first depreciation comes from the value add that you put into the property, primarily in these cases.
Exactly.
Yeah, so rehabs, those kind of things. All right, great.
The stabilized rental portfolio, those are going to be typically larger rental portfolios where you have many different units where you can offset, if one unit's empty, it doesn't drag you down to 50%, it drags you down to 99% occupancy. So those are going to be a larger, more stabilized. There, you're going to focus mostly on operational expenses. At the beginning of the deal, you're going to have to find a deal that pencils out and is going to do well. But after the deal started, you're going to optimize OpEx the whole time during execution. How can you find a way to run your asset for less? Yeah, and you can use automation tech. You handle the investments yourself. You use property management companies. There's obviously different ways of doing that as well. Passive syndications. I don't know if that's technically what you guys work with the commercial property you were mentioning, or there would be a different style. But
we're both GPs and LPs in different deals.
yeah. So the primary constraint for a lot of folks that they don't love about these is there's not much deal control. You've got the general partners make a lot of the decisions there, but there are every situation is negotiable, and the contracts are what the contract says. These are similar to the stabilized rental portfolios because they can be much larger than what you can do by yourself. They are a lot more stable. You know, a duplex, you lose one tenant, you're down 50%, right? So that's great. It's just the lack of control where some of my clients don't love that lack of control, but there's honestly a lot of folks that it's great. It's a fantastic leverage for your time. Another investment type, would be ground up development. You buy a lot, you're going to develop that to um, how fast you can develop it into something, whether it's rezoning it, whatever administrative tasks, or you want to build on it, or you want to do all of it. Depends on how far you want to go as a developer. You buy a lot, you can split them up and sell them separately. There's a lot of different ways to do this. Probably it's a very creative style of investment. And yeah, focusing on project management is key here because there are so many moving pieces, similar to the value add buys, except for you're adding all the value. You're taking the land and then adding all the value beyond that. Now, short-term rentals, those are an interesting investment. They were super popular for the last few years, but as we find with market volatility and platform algorithm risk, and not just platform, honestly, government, right? Platform algorithm and then government regulation risk. That's what I'm thinking. So, I know Grand Rapids, it's a city I'm local to. They stopped allowing any more, STRs to happen last year. So if you were in the middle of a deal and then you lost it, you lost the right to be able to send it out as a short-term rental. You now have to pivot and figure out how to turn that into a long-term rental or some other thing. And if the number's only penciled out for a short-term rental, while they have really good room rates, revenue per available room, if your investment only works as a short-term rental, it's probably not a great investment because it just takes so much work. And if Airbnb decides that they don't like you as a host next week, well, you could be out of luck.
Mm.
And then commercial assets, I think those have seen, depending on what type of commercial asset you're looking for, those have seen a little more volatility recently, but it's also a good time to buy them because of that. There's a lot more risks involved there because you've got different tenants and stuff, and it typically takes longer between turnover. However, triple net leases, there's basically everything's on the tenant. Now, you are not a landlord anymore. You are a landlord, but you're a landowner, not a landlord anymore. You're not responsible for all the small stuff that can typically take up a lot of time in smaller residential deals and a lot of management fees. All right. So here we've put together an asset yield function. This is similar to a lot of math functions that we might use in engineering. The asset yield, that's going to be your cash on cash return, basically your actual profit on the property. And yield, we typically are going to use a percentage. So that's going to be cash on cash in this case. Your purchasing power, that's the total amount of cash that you can combine to buy a property without overextending your bank account. Time bandwidth, how much time do you want to spend on this property as well? I think that's an often overlooked thing, especially for beginners, is they're going to look for the deals where they're going to probably have the best chance of success, but they're also the deals that are going to require the most amount of time on their end. And you apply your time against having a property manager and try to do it all. That's going to increase your time bandwidth and your personal expenses if you value your time. However, it can reduce our next variable operational expenses. This is what's required to keep a property running. In a flip, it's going to be everything to add the value to it and the holding, the water bills, the simple things. Apartments, you're going to have shared utilities and shared zones that you'll have to pay for. And typically, in this case, in this calculator, we can also combine whatever expenses, loan expenses as well. Liquidity is your emergency cash reserves. So this is the financial buffer that's going to absorb surprises. How much do you expect to need in case the market downturns, or how are you going to keep your asset running if you're not getting the rent that you used to be? And then risk tolerance goes into that as well. We have a risk tolerance ceiling that we like to look at too. What is the maximum amount of units that you can have with, or the maximum percentage of units that you can have vacant and still be able to make all your payments and still break even effectively? Um, so yeah, some folks are okay with the higher risk tolerance. If it's 50, or if a lower risk tolerance in this case. So if 5% of them are empty, they're okay. But if 50% of them, that would be, and you can still make money, that would be a fantastic deal. Let me know where to get it. So, all right, next we've got a calculator.
Go back for one second.
Yep. Yes, please. Yeah.
All right, so you're saying that the liquidity, like how much you have in reserve, has to be more than, or
That, that,
the risk
so I,
tolerance ceiling? Is that what you're saying?
yeah, so these are separate variables that we constrain it to, is that we have liquid cash and reserves after the deal's done. Make sure that you have enough to keep it going, and then risk tolerance is kind of a separate ceiling as well. Yeah, just these are more considerations, I guess, for most folks, but in engineering, we'll put them in as constraints.
Okay, so just to summarize what this is, so your profit is depending on how much money you put in, plus the amount of time you put in, plus whatever expenses.
It's yes, yeah, it's a slightly more complicated function, but it's effectively the main portion.
Okay, so using this formula, what does it give me?
So on the next one, we go through, and I could go through an example.
Okay,
Um, we'll pull in, sorry, find I had a good screen with an example. There we go. All right. So purchasing power, that's going to be your liquid capital deployed and your gross annual revenue. In this case, we're going to go to a duplex in Lansing, Michigan, 170,000. The rent, they're saying 2,400. You see, do due diligence, make sure this all maths out the way they say it will. But it's a solid duplex, and from what I know in the area, I'd say 2,400. Honestly, probably on the low side for a duplex. Two $1,200 units.
hmm.
Um, yeah, I know a lot of places that's impossible to find for a
Yeah,
two
one
bedroom
percent
unit.
rule, right? But that's
So
for two properties, 2,400, so it's 1,200 per unit, right? Is what you're saying.
exactly, yeah. This case is 1,200 per unit. Um, so to get to that 2,400 times 12, that's our gross annual revenue that we'd expect. $40,000 down for liquid capital deployed. Uh,
Okay.
that is probably doesn't need to be that high. You can get away with 20% down. Let me just pull up my calculator. It's 34,000.
Okay.
And then, so we're going to plug in our fixed system friction. That's going to be our base operational expenses. That's our loan expenses.
You
The
froze.
bills that come to you to own it. If there's any shared spaces, that's duplex. There's not much shared spaces. The operational cost should be low beyond the actual ownership payment. And then the labor substitute load, we're going to call that's our pro management fee. What this calculator really does is compares whether, an institutional execution versus a sweat equity execution, and values your time. So it shows you the optimal path out of the two, because time bandwidth comes in with self management, right? How much time do you plan on spending on it a month, and what do you value your time at? If you're making 200 grand a year, you value it around $100 an hour. If you're making 50 grand a year, $25 an hour. um, and also it's a personal question. Are your weekends more valuable than your weekdays? But what we find here is when we start to value our time, that you're going with somebody to manage the property allows you to use your time to look for more deals, pencil out more deals, underwrite more deals, and do the math to then make a lot more over time than all the money all the time that you're spending with the unit, because owning a duplex isn't as passive as owning a triple net, right? Or a large institutional syndication. It's more passive than a lot of investments, but you're still going to have to spend a few hours a month. And I guess that. These are all questions that you'd have to decide um, for each situation. I'd say this is a pretty nice place. It doesn't look like it needs a ton of work, but I've also been in houses where AI retouched the whole thing, and the house looks nothing like this. So I'm going to say this one's going to be okay. Not going to need a ton of time.
Okay, so let's go through the right side here. So the system
Yeah.
output, how did I calculate that?
All right. So that's going to be the 28
Oh, subtract,
system.
uh,
That's the cash flow. The 28,000 minus the friction and the labor or the sweat equity is going to be, let's see. Okay, sorry. Gross revenue minus the friction minus your personal time for the sweat equity. That's the TB right here. It's the frictional cost that we're going to calculate based on whatever we value our time at.
okay.
And then here it's going to be similar numbers, but since there's no frictional cost, the OPEX, the labor substitute load, the pro management fee is going to be rounded into that, or is going to be rolled into this. So rather than being 11.3, it's 11.3 minus 28.80 and 84.2. And so in this case, it's saying that we've got a cash on cash return estimated around 24.8% for that asset. And that's with institutional execution. Now, if you want to value your labor as zero because you like doing this stuff, that's fine. Sweat equity route, if you said my personal time aside, you'd be looking at 33.2%.
Okay. So if somebody wanted to get access to this calculator, is that an option?
Yeah, absolutely. And honestly, we're working more and more on this and adding new ones and adding features every day. But that's what my website's all about. It's got calculators like this for investors, mostly kind of smaller homeowners right now, just looking for their first house. But we're adding more investment tools on the site like this and adding features to this and whatnot.
Can you copy that link and put it in the chat if you don't mind?
Yeah, absolutely. Yeah, I'd love to. Let me find the chat here.
Oh, I know
Sorry, let me stop sharing my screen. Really good that. Awesome. All right. I have a slide or two left. Okay, yeah. So, and how am I doing on time? Am I doing okay?
Oh, you're doing great. We still have a whole nother hour to go.
Oh, okay. Cool. Well, um, so when we're doing anything with math engineering, my background, the math that's how you fine tune everything. But just understanding how variables interact to begin with, it helps you build an intuition that gut feeling, I guess, in the sense that like whether something's going to be better or worse, just so you know what you're trading off. So here we're looking at a few different variable interactions from the variables that we looked at just out in spelling. Um, Pushing your debt to the limit is going to maximize your immediate buying power and likely going to maximize theoretical returns, but it's also going to lower your risk tolerance. You're going to have, um, you know, a much smaller amount of, or a much lower percentage of units throws you into the red in that case, because you're leveraging yourself out farther, you're putting less money down, your loan payments are going to be more. Operational expenses go up as time bandwidth goes down. So as you start saying, I want to invest more, I don't want to be working in my investments as much, your operational expenses are going to go up um, when you're calling professionals for everything, or even just having a professional handle everything versus yourself. That comes with costs as well. But at the same time, you're allowed to do more value add things like finding better properties and deals. And then also the same thing as expenses, whether they're time, your personal time or operationally, as those operational expenses, that's going to pencil out that your asset yield's going to go down because that is the primary reducer in your profit there. And therefore, your profit goes down, your yield's going to go down.
Okay, so that's an inverse
Yep.
kind
So
of
these are
relationship
all,
between these. What's that?
yeah, yeah, these are all inverse relationships. Exactly.
Yeah. So, right. So the 2008, everybody pushed their purchasing power, had more debt, more debt, more debt. Then everybody got shot. Not everybody, but a good number of us were shot down.
Well, and that's where the risk, and I find a lot of folks that are younger that grew up during that time that are coming into they have a very high risk tolerance in the sense that they do not want anything that can fall apart as easily as it did in 2008. And I have to explain that, it's a once in a generation thing, and that's already happened in our generation. It's not recency bias is real though. I think people look back and they recognize something that's happened, but at the same time, that is a worst case scenario that you have to plan for as a 2008. Um, what do you do with your assets? Values cut in half. You can't refinance it.
Yeah, exactly. Oh, Daniel said, I wish I'd purchased back then. It was cheap. Yeah, after the crash, Daniel, not before. Ask us how we know.
uh,
Yeah.
my, yeah, I know people that were burnt, and yeah, I look back at buying houses in 2010, 12, and I couldn't have done it yet. I'm like, I probably could have, and I probably should have.
Yeah.
So, yeah, I guess getting into the next
What you knew,
portion.
correct, Dale.
Yeah, looking further at these stress testing, we don't have a calculator out for this one yet, but we want to understand what value variables are going to directly impact your bottom line. Um, Make sure we have room for those errors. What happens when we refinance after our balloon payment? The interest rate goes up. How is that going to affect our IRR? Uh, we do this all with spreadsheets internally right now, but we're working on a public tool for everyone. Economic vacancy. What happens if, we go from a state where vacancy in your area is 8% to 12%, and you have to have a more planned 12% vacancy? What does that do to your IRR? And it's really easy to look at these both in a vacuum and say one or the other. But there's also situations where the worst of the worst happens. And are you still making money on that asset? In this little illustration, we are, but you have to pencil that in for every asset and know that if you can, how long you can continue a negative IRR, right? How long can you continue putting money into an asset that's uh, losing money, right?
So in this case, like, let's say I have a 30 unit property. How will I know? I mean, all right, so it's fixed rate, so I wouldn't have necessarily an interest rate surge unless I refi, right?
Yeah, that if you had a fixed rate for, I know a lot of investment properties, especially the smaller ones I was looking at. For examples, a lot of them had land contracts, right? So that could be a zero. In that case, that's a zero risk situation, and you wouldn't even look at it in that case.
Okay.
'Cause,
Let's say we had four vacancies all of a sudden. I mean, these are hard to predict. So when in the cycle are you looking at this, this financial modeling stress test? Because, let's say typically you have one or two vacancies. But all of a sudden, something happens, a lease renewal, three other people decide to move out. So now you have five. Like, when do you start using these tools?
you should know at the during the underwriting phase what they're going to do to you, what all possibilities are going to do to you in that case, whether it's three or four or five. Um, Vacancies, you'd use this at the beginning to understand what do you expect. I mean, if you have 100 units, you can say between 10 and 20 might be vacant, and a really bad time, maybe up to 30 are vacant, right?
Okay.
But and you would really plot out each situation and it will show you the range of possibilities based on what you expect, because a lot of this is looking into the future. We know that over time real estate always goes up, but we do have to account for the fact that sometimes over 4 or 5 year periods it's going to go down, but over 10-year periods it always goes up. So we can calculate the full range of possibilities for vacancy and everything else based on historical trends, and not just trends, but what has actually happened, right? You and I agree that real estate's not going to go down 90% tomorrow because it's never happened. But it can go down 50%. We've seen it, right? So um, that's where a lot of these come from, is analyzing the situation from a real perspective of what can happen, not what you fear will happen, but what has happened in the past and what is likely to happen again in the future.
Okay. So at some point, like it would tell me that if I had a 30 unit, for example, and 10 people, left, that would not be a good deal, but there should be some point at which, let's say 7 left or 5 left or 3 left, I could still manage the property effectively.
Exactly. And then you start to understand when when those, when you turn negative, right? Because that's when it becomes untenable to manage the property anymore. If you're losing money, that's what the cash reserves are for, is to float it for so long. But, and I think what I'm finding with a lot of this too is that's the beauty of a larger unit, is the larger deals are going to have a lot less volatility, because the more units you have, the more your numbers converge on an average. So with 1,000, you're going to be much more close to the vacancy average for your area. But if you have a duplex and that's all you have three options for vacancy: 0, 50, or 100.
Yeah, right. We have a
So
question from one of our guests, Dale.
yeah.
Wanna?
So if you are running these numbers, and forgive me, this may be a multi-part question.
Oh,
So
please. Yeah.
I'm assuming, and I'm not a numbers person, but I guess my question is, you don't want to run these every day or every week, because you're probably going to create a fair amount of fear in yourself. But let's say you run these quarterly. Is it possible to set, or I guess you should go into this once you run them the first couple of times, knowing what your number is when you need to start making some decisions about what to change and what your next pivot point is? Or is that how you decide, when you need to make a decision?
Yeah. So this is ideally a set it and forget it, but not necessarily forget it. It's a set it for while things are stable. If you know that what your range of scenarios are before you need to do something. If you have no more than 6 units, you're looking at this and saying the worst case scenario is 6 units, um, and you have all of a sudden you have 8 vacancies. The economy is not looking good. That's when you're going to go back and take another look at this and relook at your possibilities for the next few months, or the next the next future. Ideally, your vision for the future shouldn't change much while you hold the asset, but um, things do change. The asset could be worth a lot more, and maybe you have to balance that against a new vacancy limit versus your payments. This is used to make decisions when decision time comes, and then really when you make a decision, the best thing you can do is stick with it until you're ready to make another one, and then make another decision to change direction and course correct whatever you have to do. But I would recommend, to your point, you don't want to get um, analysis paralysis, right? You don't want to let the fear take over. Um, check the numbers and start making phone calls. Start talking, making deals, right? This is just so you know what the possibilities are, so you have the leverage, because sometimes the information looks like it's one way, but hey, this is something that's got a lot more volatility in the rents in that area, or regulation or other things. So you might find deals that other people don't see because you know that the possibilities are there and you've already mapped them out. And you also find some dogs that some other people are going to be willing to pick up, but you're going to avoid because you looked at the possibilities and hey, this pencils out really great as an STR, but man, if we got to turn this into a long-term rental, in that case, you would read look at the numbers, right? With the city came in and said this can no longer be a short-term rental, you have to make this a long-term rental. So I guess to summarize it, this is a seasonal approach, not necessarily a quarterly or really a repeatable approach. Just as seasons in the market change is when you should look at these.
Thank you. And was there another part question?
Yeah.
No, I think that was it. I think. But that was a great answer. And it did answer exactly what I was trying to get at. So thank you.
Yeah.
I'm glad.
I think some of this also drives your reserve percentage, correct? Because, you want to have a reserve for the worst case scenario, is what I'm thinking.
Yes, absolutely. And yeah, as you see those scenarios and those scenarios are changing over time. Like I said, when the market changes, all of a sudden you thought your worst case scenario was 6 vacancies, now it's 8, and it looks like it might be a couple more next month. Well, how does that's when the math changes, and that's when it's time to dive deeper and look at and that's exactly it's going to run. Like, hey, we're still making money, but we're 8. Maybe the worst case scenario is 15%. Well, what it was our 15%, 15 vacant units. Now, what does our reserve need to look like for that worst case scenario?
Yeah.
So just as a follow-up to that, I
Yeah.
guess that also could then alert you that maybe it's time to look at marketing differently for that property, or if something, I don't know, maybe your rents are too high compared to another or several other properties in the area. Could it do that?
Yeah, and that's why I like the engineering approaches. And that's what I did as an engineer was as numbers focused as I look here. They're just numbers. They're just symbols on paper, right? Numbers are here to drive action and to drive what we do next, right? And exactly, if your vacancy's shooting up and you're looking at, this, you can look at, hey, do I need to change my reserve so I can handle this vacancy? Or exactly in that case, there's probably something changing with the market that I have to react to instead of that. And then, okay, now I have to lower my rents. What does a lower rent look like in this situation?
Yeah.
Yeah, so numbers are meant to drive decision and action. They're not meant to just be there. I did a lot of spreadsheets in my day, and I think my favorite line that I would tell my teams, I'm like, we're not here to build spreadsheets, we're here to build trucks. Let's, don't overcomplicate it, just get it done.
Right. Build something we can use to make a decision.
Yes, exactly. And that's what all my tools are based on is decision making, not over evaluating anything. But there's certainly more numbers than some folks are used to.
Yeah, and Dale, to put a real world example to what you were just asking about. So we do have a slight increase in vacancy in one of our properties. And so we have been doing, reviewing the numbers and looking at different options in marketing. We tried Facebook ads with boosting the ads. We've done apartment.com. We're tried different move-in specials, if you will. So there's different options that you can take when the numbers hit a threshold that is looking risky.
Right.
What did you find was the best? You said you ran ads on different platforms. Was there a better one than others?
Now, Facebook Marketplace with a little boosting is working better than apartments.com. And apartments.com has an interesting requirement. You actually have to go into the site every single day and click a button that says, yes, this property is still available for
What?
Yeah, it's annoying. So,
So then,
you know,
Uh,
at the same time,
yeah.
the property area may not be exactly the type of area that apartment.com, people that use that service look at. So, it's situational, I would say. Um, but we're finding
Okay.
Facebook and uh, different move-in incentives seem to have a better impact.
Yeah, that's, I shouldn't say surprised. I guess I am a little surprised, but I mean, Facebook is the king. They're everything now.
Yeah, I mean, we're not using Zillow, so maybe that's another option for people.
and then interesting point there, Donna. So using this tool, if you had to go in every day to set that to say that yes, it's still available, then now I'm thinking that in that tool, you then have to raise the number or adjust the number that talks about how much time you're willing to invest into this because I wasn't planning to do that every day.
Yeah.
Maybe you could put
Exactly.
that at, I do this once a month or once every 2 months or whatever. But now if you have to go in every day and spend 10 or 15 minutes maintaining just that or even other
Yeah.
aspects of this, that's a change.
Absolutely. Thank God our property manager has a VA who does this for us.
Well, there you go. There you go. So that's covered in your OpEx.
Yeah,
Yeah.
exactly. And
There's a
that's,
cost for it, right? So, how much does it cost to log into a website and flip a button, It's crazy. Yeah.
yeah, I guess it's probably nice that they don't have too many spams or, things that linger after they're rented. But at the same time, that I got to imagine that friction eliminates a lot of good units for people that don't want to go in every day and click that button.
Yeah, absolutely. So there might be, like you said, exactly, people that have properties to rent that just won't go through the effort. Hmm. Do you
Yeah.
have another slide?
Let's see, do I? I think I got a couple more.
Okay.
Oh yeah, so we can go over some OpEx. We're talking about it right now. Administrative, right? We've got, I don't think I have this example here, but a VA to click your button in apartments.com, uh, property taxes, death taxes. It's the only certainties we have. The government's always going to get their cut. There's other things you can do with bankruptcy, whatever. For other things, they'll always get their cut. Landlord insurance, that's not going to be your typical homeowners insurance, right? You got to cover liability, other ideas, other legal risks that come with having um, people live in an asset that you own. Routine maintenance, that's something where back on the time calculator that can really eat up that time of yours. If you're mowing the lawn at your properties every day, you're trying to find ways to save money that way. Um, but that also does add up on the OpEx side as well, and that's going to go up every year. The lawn guy's probably going to charge a little more next year, right? Um, owner paid utilities, depending on the asset. You've got common hallways, water, and sometimes owners, the landlord or owner is going to pay the utilities based on, hey, no one's everyone's water bill is pretty average. It doesn't seem to fluctuate too much, so we'll just keep that in the rent and we'll have it all on one water meter instead. So those are any owner paid utilities, whether it's a common area or not, you have to factor in and allow for some variance. Based on seasonality and really changes in electricity, fuel costs, and everything else. Uh, and yeah, administrative and legal, not only the VAs, but your accountants that have to help you file your taxes if that's not your cup of tea. But again, that can just go back in the time bucket too if you want to save. That's something that you're capable of. Um, Legal, you'll probably need some contracts, some lawyers to look over some things at times, depending on how complicated your structures are, and they're not cheap either. So yeah, I think that is it for this slide. I think this was my last slide.
Okay, so in this case, these are uh, operational expenses to account for in your underwriting, right?
Yes, and to keep a very loose eye on as things change seasonally. Electricity costs are, I think right now, the wholesale cost of electricity is up tremendous amount in a lot of areas, and that's eventually going to get passed down to the consumer. So I would say, owner pay utilities that has a lot of volatility right now. If your margins are that razor thin, where a double in electricity is going to cause some changes need to be made, that's where I would say the relational understanding of everything, like the if this goes up, that goes down, is very important, because knowing that, hey, I'm making 30 grand a year on this. If my electricity bill goes up $200 a month, okay, is that really gonna cause me a big issue? It's something I need to keep an eye on. But 30,000 minus 2,400, you're still doing okay. You're still at 27.6. That asset's still doing well. You figure whatever your yield percentage is, you're making money, right? Um, but then you look at things like insurance or property taxes, depending on new bills, those can go up by thousands of dollars. A lot of these are small, but I think it's just understanding where they are, and are a lot of these hitting you at once that could completely change your the future on your asset. Mostly at underwriting, but yeah, a seasonal thing after that.
It kind of hits that landlord dilemma, right? You don't want to raise the rents always on the landlords, significantly, but then your property taxes go up, your insurance goes up, your utilities go up, but then you get to the point where, like, am I gonna max out the market for rent based on this? And then you're like, oh, do I sell the property because it's not valuable anymore?
Exactly. And these are, landlords get a bad rap, but the more you dive into it and you figure this out and you start to really break down the problem piece by piece, owning property is a job on its own. I own my own house. I love it, but there's a lot of work that goes into it. So whether you're owning something for yourself or other people, there's a lot of work that goes into it. So, um, and these go up every year. And like I said, taxes, there's no running away from that. And those only go up. Um, so you have to offset the rents, and then, the middleman's always the bad guy, I guess. So, I mean, that's where we're at.
Yeah, but the numbers are important to help you figure out whether it's still viable. I know our insurance went up, and so I was looking at the numbers going, okay, we're still making a profit, because if not, it would be time to sell on a single family rental that we own.
Oh, and exactly, that's where the volatility is going to be the highest, right? That, you know, zero or one vacancy, right?
Exactly. Exactly. So if you could all summarize this for, aspiring early real estate investors, from an engineering perspective, when they're looking to get their first investment, what would you summarize as?
I think that what the numbers driving action, numbers drive action, and that's what numbers are here for. They help you analyze the deal, but the analysis is all about driving action and taking the next step. I think that we see here the numbers. There's a million different ways to calculate them. You find a way that makes the most sense for you, and you find assets that you want to look into more, and really attack it. Don't let the numbers get you caught up. Don't let the analysis paralysis set in too much. Make the decision and move on. You can always make another decision later. Calculators will still be here.
Hmm. And I know this is your contact information.
Yeah, just mine.
If,
Nothing.
um, so do you have any other calculators on your site that would be useful to share right now?
Yeah, we can go over.
And how did you come to build these calculators in the first place?
So I've gone the traditional real estate process for a while. Going working with agents that I just find whatever who's ever card I come across, and I found, I had my first agent laughed at me when I tried to show him a spreadsheet. So like, going way back to that, you know, these folks didn't want to talk about math or spreadsheets. So I looked at, I'll pull in this, and what I was finding was, um, my friends and stuff wanted to talk about the math, and my colleagues and everything else, and want to really understand, is this a good time for me to buy a house or not? Is this, how do I make these decisions? Because there's this kind of like sales aura over it. So I wanted to change that and help folks with making the decisions on a smaller basis. But as showed here, we're looking at more investor-based tools now. But we got all these tools for basic cost of living analysis, debt to income calculators.
Yeah, if you're still sharing your presentation, so
Oh, yeah, okay.
I thought it was me, Donna.
You see it now, or let's try this.
if
So
there's
yeah,
somebody that is thinking about buying a first-time house, some of these
yeah,
estimates would also come into play, or these calculators.
yeah. Because I think there's a lot of people that get in their head that I can or can't do something, and so here's what it is. What it is. I already determined what it is, but sometimes it's a little different than that. One of my first phone calls when I was reaching out to my sphere, trying to do some more realtory things, was to an old colleague, and his quote was, "Do you think $200,000 enough is for me to buy a house?" And like, he's in California, so granted, it is a lot more expensive, but even at $1 million for a home, 200's plenty, especially with his income and everything else. So, um, it's really where a lot of these ideas came from. Was there's a lot of uncertainty, and it's like, I heard this. Well, it's like, it's not that for everybody. Everybody has to make their own decisions based on whatever decision criteria they want. Engineering, we just use math, we just use calculators here. So we got like, and we quantify the costs of commute and everything too, because that's something. When I was looking at buying a house, I didn't look at pictures. Actually, this house I own now, I never set foot in. I only looked at the plot of land that it was on, and I said, I like where it's at. I like, it's connected to that plot of land, everything else. And my wife's like, it's hideous though, and I'm like, well, we'll fix it. That's what we do. But and so I'd like dive in, and if you're driving to work every day, a lot of my clients are engineers. They've got a job at an office, and your one way distance and time, depending on how many days a week you are in, really got to calculate the cost of the commute, because that adds up really fast on both the hourly value for your time, like we talked about there, and the gas, which is so it's even worse right now. But where depreciation. Um, but if you change this, and let's say, okay, we're down to 15 minutes and or 15 miles and 25 minutes instead, you're looking at a vast difference in a house year to year. If you want to look at your time and things that way, it depends on how deep you want. I wanted to answer every possible question. I worked with a lot of engineers, so there's a lot of questions to answer here.
That's neat. So it tells you
And
the annual cost of commuting. Thank God I work from home.
oh yeah, me too. That was part of becoming an entrepreneur. But yeah,
Yeah,
HOA values.
affordability calculator.
This one, I think, yeah, I just did a video on this one earlier because I think it's so important, because what banks are willing to give you does not mean, especially as your personal home, does not mean you need to take every penny they're willing to give you. You know, are you happy? We define here 28 to 36% is kind of when things are, like, depending on what your personal situation is, when you might want to start to take a closer look at it. And over 36 is you're starting to get into a riskier zone where I know some banks will loan up to 50%, right, of your income. So,
Goodness.
um, and I know people that have taken those loans, and they're not living comfortably, or not 50, but in the 40s, and it's just like, that's
A lot of
That's not
stress.
not a way to live. Yeah,
Yeah.
exactly. The
Yeah.
stress just trying to make up.
Maybe
Um,
cheaper to rent. Dale,
yeah,
rent versus buy.
yeah, and oh yeah, our rent versus buy calculator. Um, build versus buy. It's my rent versus buy. So this one looks at your time horizon, whatever the equivalent monthly rent is. So in this situation, I think I got 2,300 and I found a house. I found two comparable homes at 350 and it was 2,400 for a comparable rental. Um, we'll just keep all these assumptions the same, but you can put all these in. The idea here is, do you rent and invest your money? Because typically rent, you might save a little bit over a mortgage. And a lot of people are like, well, it's $300 a month cheaper for me to rent right now than it would be for me to get a mortgage on a similar house. And they get so fixated on that. But it's like that house is going to go up. Your rent's going to go up, but your mortgage payment's going to stay relative. Your principal and interest is going to stay the same during the cost of your loan. So how does this actually net you over 10 years? So the thought is, if you rented, you save a couple $100 a month, whatever your market return is. You look at the alternatives and you look at your buy scenario. You buy, put more of your money into a house, or rent and invest your money on the side with a delta. And I mean, just the math follows a lot of conventional wisdom. You can, if you're going to live there for a year or two, you probably shouldn't buy. If you're going to live there for longer, you should probably buy. Um, and yeah, these numbers are all just they're projections. They're what you think the future looks like for things. So we can't say what home appreciation is going to be, but I can say over the last 50 years, if you bought a house, in 19, what would have been now? Oh gosh, 76, and had it now, it would have gone up on average 4%, 4.1% every year.
Mm.
But that's volatile. So I think everyone needs to put in their own assumptions there. And that'll also show in their risk tolerance as well, right? If they think it's only going to go up 2% every year, they're going to find, that their assumptions show, oh yeah, it's probably not a good time to buy a house. And if they think that housing's going to be at 1, 2, 0%, well, maybe you shouldn't buy a house. All I know is average is here. I think certain areas you're going to see probably more like 5 or 6%, 10% over the next 10 years. Certain areas you'll see less. It's a lot of variables that um, we can talk to, but it's up to the individual to make their own decision on what they feel is going to happen.
Yeah, I mean, I know it's market driven, but how do people know what to put in this home appreciation bucket?
Uh, it's almost a gut feel, I hate to say, but in the video I explain, there's different periods of time, and that's another calculator I want to put in to show like, hey, you're going to own for 10 years. Here's all of the possibilities that have happened over the last 10 years. Here are all the 10-year possibilities that have happened over the last 50, 60 years. And then you can see a distribution curve of all the possible outcomes there as well, based on just historic data.
Mm.
That one hasn't been built yet, but that has been in the back of my mind. So exactly. So we can help people answer that question. Are they bullish? Are they bearish? Well, here's the curve. If you're bullish, you'll be on the right side of the curve. If you're bearish, you're on the left side of the curve, but the numbers are probably going to be somewhere in this curve.
All right, Dale has another question.
Yeah.
Forgive me if it was visible on the slide and I just missed it. How do you assign a numerical value to your risk tolerance? I know you're just talking about whether or not you're
Yeah.
bullish or bearish, but if someone's new to, I guess, and check me on whether or not this is a calculator for someone buying a home or someone buying an investment, your tolerance may be different from one to the other. For buying a house for yourself versus buying an investment property, how do you determine, I guess, what your risk tolerance is, and then assign a number to it to use in the calculator?
So in this calculator, we don't actually put in a risk tolerance calculator. I would say so. Where risk tolerance would come in that case is, let's see. I know where you got that, and I was kind of worried about how I inserted that in there. Where I meant risk tolerance is going to show up through the numbers. a risk tolerance is something that's not normally, it's very difficult to quantify. You can do some decision tree work and some kind of interesting math that I've done a while ago to really understand your personal risk tolerance. But what I meant in that is for home appreciation, somebody who's going to be, let's say, a more risk tolerant person, someone who's more prone to taking risks, okay with taking risks, they're going to be more likely to put in, hey, yeah, the market's going to go up 6%. My max vacancy is only going to ever be 5%. Whereas on the opposite side, people who are very afraid of risk are typically going to put in numbers that are going to be more fearful of the future. Hey, the home appreciation might not go up as much, um, but there's a much higher occupancy rate than's actually normal. So risk tolerance, I don't quantify in my calculators. I like to look at averages, best case, worst case scenarios with my clients. Like I said, I think the more risk tolerant you are, you normally like, oh yeah, you're gonna be biased towards, oh, it's probably gonna be great. People who are less risk tolerant are gonna look at it and say it's probably not gonna work out. So it's almost optimism, pessimism, I guess.
Yeah, I mean, for underwriting a rental property, we tend to be on the conservative side and recommend that for everyone. But
Yes. Yeah, you should be conservative, realist. Absolutely.
On some of these percentages, can't you actually ask like chat GPT to give you the time frame for that area too, and what the average appreciation, like a good example, was for
yeah,
the last 10 years or 20 years, and it could actually get that information for you, couldn't it?
Oh, absolutely. Yeah. I
Yeah.
mean,
So
uh, with AI and everything now, there's no answer that we're going to answer here that they can't answer, right?
yeah,
To me,
yeah,
I'm more about how do we present information? How do I answer the questions that people don't even know they have?
yeah,
yeah.
And they can use Chat GPT to fill in the rest, because yeah, different areas are going to look differently, and
yeah, absolutely. Hmm.
but also, you can't completely plan on history repeating itself either way. So you look at the variables of what happened in the past and or the range of what's happened in the past, and you look at those as all possibilities that can happen in the future. And then some, right? There could be black swans. There's things that we didn't know exist that are going to happen. There could be an AI bust, we might have universal basic income, who knows? But it's all I know is that,
Might
what
live
we've
on
seen.
Mars too, right? We
Yeah,
got to
exactly. Maybe there'll be a real estate boom there.
be the first realtor on Mars. No.
Elon's going to be there.
Yeah,
He's
I'll let
he's
him
going to be
have
selling houses up there.
it.
Yeah. So let's just open up to a wider audience, and thank you, Dale, for all your questions. Does anyone else happen to have questions for John? I know this is not a shy group, so let's see who's here. I'm going to call people out.
I don't have a question. I just want to shout out. This is a really great website. I'm looking at the website here and really nice tools you've got there. So kudos to you.
I appreciate that, Zeph. It's been a lot of work and it's been
And
fun.
speaking as an engineer, I'm also an engineer, so I kind of appreciate what you're doing here and the look and feel, how it's reacted and it works well. So it's pretty cool.
Yeah, and
Good. Yeah.
now that you're becoming a realtor, also, these tools
Yeah.
will be helpful for you to help
Yep.
people decide
I've
whether they
got
can
my own
rent
little
or buy.
spreadsheets. I got my own spreadsheets, but I like this as a visualization. It's really nice the way it's laid out here. So very
Yeah.
nice.
And Ken, you too, as a realtor, can use these tools to help people decide rent versus buy.
Yeah,
Thank
absolutely.
you, Zeph, for your feedback. All right.
Yeah. And then, yeah, in Michigan, we've got the listings as well. And right here, we've got Google Street View integrated right into the house search because all of my house searches also included a Google Street View. So what does the house actually look like? And this one looks, which one is it? This is always fun too, is when you have a flip house like this and it's like, which one was it? It was this one over here. Beautiful house now, hopefully. But yeah, another little tool I like to highlight.
Yeah, so what API are you pulling from here? Is this a Zillow or
This is called Showcase IDX. The reason I went with them is it's got a lot more information down here that they include with it than other um, folks will. It'll show some demographics and guys for and then over here it was reasonably easy for me to use a screen looker to have our incident analysis tools pull up the numbers right from here uh, and just plug them in. Hey, we've got property taxes pulled up. Here's what the incident analysis. Here's what a home with this down payment and everything. You just quick numbers should pencil in at around 25,676. Um, Affordability calculator and everything else just populates based off of this, and then these numbers will stay with you as you're logged in. I think adjust those. Obviously, it changes that. But your commute calculator, I've got my office in here just for showing. But if you put your work in here and you go look at a different house, it's gonna recalculate the trip based on a new address.
So are you expanding this beyond Michigan or are you um oh something froze. Ken, can you
That's the goal. Yeah, currently we're focused with Michigan with the IDX and looking for something else. And she actually lives in Florida, so she's licensed down there. Oh, hello. You see?
Hi. Yeah. Can you hear me?
Okay, I can hear you. Can
Yeah,
everyone hear me?
there's a little freeze for a second.
Yes.
Go ahead.
Yeah. So the next thing we're gonna do is Florida. That'd be the next state, and then yeah, as we find partners in other states that want to work with us, and figure out how to get licensed so we can get the IDX on in those states, we'll turn it on in other states as well.
So are they
I'd
real
be
estate
interested.
partners?
California.
Or what? Okay,
Sorry,
so partners
was
I
saying,
use as referral partners. These are people I refer business to. I don't
Steph is
necessarily
in
have a lot of.
California. He said he'll do it. Ken is in New Jersey, so
Is that
yep, I'm in
okay?
California. I'm very interested in, talking about this with you.
Absolutely, Zeph. Do you mind sending me an email
Yep.
to? I can put it in the chat here, and we'll grab some time. And anybody that wants to talk.
Yeah, we should connect. What's
I'm
the
gonna.
email? You're putting in the chat?
Yeah.
Okay.
And Ken
Sounds
is also in New Jersey, so as a realtor, he can jump in too.
Yeah, absolutely.
I have a group
Yeah.
chat if you want.
No, I'd love to. Yeah. So yeah,
So,
there's my email. Yeah, I guess what else can we talk about? I don't know.
okay, Daniel, any questions from you? I don't hear it. All right, Nigel, I think you're on also. You here? All right, maybe not. And Nisikin, have any questions?
Hello, can you hear me?
Yeah.
It was pretty
Yeah.
much self-explanatory.
Yeah, good morning.
Oh,
Can you hear
Yeah,
me?
I want to ask a question.
Yeah.
It work it global, like people that in Africa right now.
what is your question? He's calling from Africa right now.
Yeah, I shall. Is it working like global? Your website is it? Can I have for me to share it for some people? You need people that are
Yeah.
going to work for you.
I mean, the real
Yeah.
estate part isn't, but the calculators would work, right?
Yeah. And that's part of where the design for this came from too. And working, I was all over the country and like I can't get licensed in every state to work in every state. So how can I build a referral business that can go to every state? And there, as far as I know, zero reasons it won't work in Africa. Please let me know if it won't, and I'll work with some of my web team to figure that out. But it should work there, and the numbers, numbers are numbers. They'll apply there as well.
I'll put the website in the chat. It's let me see.
I can do that real quick.
Okay. Yeah.
I can copy and paste it right here.
Easy, easy. Love copy and paste. All right. Ken, any questions from you?
No, that's pretty self-explanatory. So yes, appreciate it.
No, thanks for having me. This has been fun.
Good. All right. So I can see, how we can use this for both referrals for real estate and people, first timers, and then also for investors. So just to separate out the two, what would you recommend would be the best tools for investors on your site versus the first timers?
I have an investor section coming soon. And so the tool that you guys saw today, that one's live. We're building the rest of the tools right now. I can share those with everyone on the call once that goes live here in a couple weeks.
Okay, that sounds great. So what do you foresee in the investor tools?
All right, so investor tools, as we're putting that calculator together, I was a little working on it, and I'm like, well, I'm kind of making an assumption here, and I'm making not assumptions, but I'm doing the math separately, to bring it into that calculator. So I really want to expand that one, and then dynamically show how the further downstream variables are affected in there, as well as really just figure out. I would love, so down here, I don't have them here yet, but I'd like to have a simple analysis tool similar to this instant analysis, pull in new rent estimates and everything else, and have an instant investment analysis. Shows you what an asset could
Rent
yield based on, the rent estimates. We work with some affiliates with a rentometer and stuff. So we're building out that. What I found was that the calculators are something that can be competed with. The information for investing, I don't know if you guys use PropStream or anything like that. Compiling all the deep data that anyone can purchase is just that's a beast of its own. So we'll see more calculators and how to apply the information that you find on deeper sites than the MLS, the sites that show you who owns every piece of property everywhere. I pay for a couple of those sites, and I've looked into adding those features, and those are very once I go public, I'll add those features. They're not cheap to add.
cost prohibitive at the minute. Got it.
Yes.
They're high risk.
Yes. I think I went to showcase. I'm like, oh, I love the information you guys have, and they have a whole suite of information I can have, and they're like, yeah, our packages start at like 60 grand. I'm like, okay, we're doing okay, but we're not quite there yet. We'll call back soon.
Nice. So any last parting words for us here?
You're the master of your own destiny. Take it and run the math real quick and go. Let it drive you.
Awesome. Well, if there's no other questions, we want to thank you so much for being our super guest tonight on
Thank you for having me.
Steel.
Thank you.
Thanks a bunch. It was pretty good. Very informative.
Thank you. In
Appreciate it.
about a week or so, I'll have the replay up and running, and I will send it to you.
Appreciate that. Yeah. No, I thank you for giving me this opportunity, and I'd love to talk more soon.
Yeah, let's keep in touch.
Will do.
All right.
Thank
Thanks,
you.
everybody. Good night.
Take care.
you.
Night.
Good night. Thank you.
The recording.